Alrighty, ladies and gentlemen, welcome. It is Wednesday, June 26, 2024. Tom King here, coming to you live from a recording studio here in Nashville. And if you hear a little noise in the background, that is not me playing anything. Those are artists here that are recording songs for an album. And there's a couple of them working at the same time here. So I'll do the best I can to keep this rolling. And stay focused. And tonight, I want to spend a little time on my favorite subject of all, and that's hedging. Yes, hedging. You know I love hedging. Actually, you're wrong. I freaking hate hedging. Okay? It's the worst subject. I don't like to talk about it. Okay? I hate it with a passion. Okay? It's a necessary evil. Everybody gets all excited about talking about hedging, and you got to hedge. And so why are you talking about it, Tom? Why would you even go into something that you can't stand talking about? And let me tell you, there's a handful of people out there that are such negative Nellies anyway, but I got to post those comments in the YouTube channel. You're going to get everyone killed. You're going to blow up your account. You're going to be wrecked. Well, I'm on my 38th year of trading, and I haven't blown up my entire account yet. Have I lost money? Absolutely. Mostly because I was stupid, okay? Not because of something else that I needed to hedge against, or a hedge would have protected me. It was the fact that I didn't know what the heck I was really doing at times, and I was trying different strategies. But I will say that I do hedge. Well, how I hedge might be different than everybody else out there. But I want to talk to you again a little bit about hedging. And when we get into hedging, what are you trying to do? What are you trying to avoid? What are you trying to mitigate? So number one, how do you do this? Okay. I'm trying to hedge against a typical loss. Okay. Well, you have a couple different choices when you want to start to hedge, and you got to figure out what is it that you're hedging, and what parts of my portfolio. Are you going to hedge the whole portfolio? I have gold, I have oil, I have bonds, I have the S&P in there. Sometimes I have live cattle. Do you have to hedge them all in case the market goes to hell tomorrow? No. Hedge what needs to be hedged. Okay? Look at particular trades and figure out which ones are you going to hedge. If the S&P goes down 20% tomorrow, what's going to happen? Okay? Is my oil going to get affected? Probably not too bad. Is gold going to be affected? Probably not. In fact, gold may go up. Will bonds potentially go up because there's a flight to safety? Maybe. Okay. So understand what you're going to hedge. And all of you naysayers out there, Tom, you're going to blow everybody up, and I can't wait till you blow up. Okay. Keep hoping, keep waiting. Okay. Maybe it'll happen one day. Okay. But there's a couple ways to avoid that happening. And I want to share some of those with you. If you want more specifics, obviously we cover this in depth with our members in the Discord. This is free YouTube. I'm giving you guys lots of great training and advice, but if you really want the specifics, you're going to have to come and join up. Well, why are you going to make a paywall for this information? Because it's valuable and it works, and I can. Okay. So anyway, let's get back to hedging and talking about it. All right, so what are you trying to mitigate, and how do you mitigate these losses? What am I hedging against? And I'll talk more specifically about that, but I'm more worried about ES doing something, ES futures, or the S&P doing something, selling off hard. Okay, but when you're really thinking about it, what are you worried about? Are you worried about the black swan event that's going to potentially happen, like COVID or something else that happens once every 20 years? Or are you worried about the 10 to 15% downturn that happens about every 1 to 2 years, okay? Which we're probably overdue for a little bit right now? Which event do you really want to hedge? Something that happens every couple years, or something that happens every 2 decades? Okay? Because every hedge is going to cost you money. There is no such thing as a free hedge. Okay? You know, Tom, there's all kinds of ways to pay for your free hedges and put them out. No, there's not, and I'm going to tell you why. Okay? But I want you to listen up a little bit and just understand what I'm telling you. Number one, you've got to be smart. Okay? How do you avoid blowing up your account or something, especially when you're trading like I do and many of our members, where we trade a lot of futures and we sell naked puts on a lot of different futures. Absolutely. Are there risks there? Yes. Okay. You have margin that can expand significantly. You can incur a margin call. You can take significant losses when you're using large leverage. All of these things can happen. You have to be aware of it and do your due diligence. Okay. As I say in my description, this is entertainment, this is education. Okay. You need to also educate yourself. Who are you learning from out there? But if you're also the person that's saying puts are deadly and puts are dangerous and you're going to blow up, then you're completely uninformed about how the markets work and you don't really understand it. Okay. Selling puts is extraordinarily common. It's a very high probability type of a trade. And if done properly, it can be done to mitigate any potential significant problems that you have, okay, for the most part out there. But you have to realize all trading comes with risks. All trading, you can lose money. It's up to you to be smart enough to put a plan together. So a couple ways you can hedge and protect your portfolio. Number one, position sizing, making sure that you're only risking a certain amount of capital per trade. For me, on let's say most of my trades, I have a 2x or a 200% loss maximum is what I shoot for. Okay? If a trade loses twice the amount that I took in, okay, which would be a good little loss for me, I size that to be less than 2% of my entire portfolio. So if I lose on any trade, it's less than 2% of my entire portfolio. Okay. Can it blow past my stop at times? Sure. I can lose 220%, 230%. I could even lose 300% on some if I'm not paying any attention to the market. But for the most part, I am always able to get out within a couple percentage points of that 200x loss. Okay? And I don't have to sit there all day and worry, oh my goodness, is something going to happen? Tom, we're getting close. We're getting close. I worry about it when it happens. Okay. You don't need to be that nervous if you've sized properly. The only people that are nervous when something's getting close to a 2x loss are the people that traded way too flipping big. Right, so position sizing. Size it so that any loss that you incur on a trade is less than 2%, 3%, 5%, whatever you're comfortable with. Okay, number one. Number two, you can manage your margin. Why do I only trade up to 50% of my margin? The biggest thing that you're going to run into on a sell-off is a margin expansion event, which means your margin can go up 20, 30, 50, 100% or something in a crazy sell-off. What you want is to have enough margin where you can start to place trades, roll, take assignment, do any of those types of things that you need to. You can't do any of that if you run out of margin. So trading with 70, 80, 90% of your account, to me, absolutely foolish. I trade with 50% of my account. Okay? That way, I know that if something happens and the margin expands, I can make the moves I need to get out. So margin management is another way to do it. So you've got position sizing, you've got margin management, okay, and then you've got hedging. How do we hedge? Well, there's two ways to hedge. The first way is to set stops, okay, and limit the damage before it gets started. Okay, so we want to limit anything that could potentially happen in the account to begin with. So I'm going to show some examples for you in just a moment or two. But stops are the way to do it. I just mentioned a 2x or a 3x stop or whatever it might be. If you have stops and you can pay attention, you can get out of your trade. Okay? There's going to be opportunities to get out. I want you to remember this phrase: every large loss started with a small loss. Got it? Every large loss started with just a small loss. The only way they become large losses is if you don't stop the loss when it's small. Okay? Yes, there's times where it could potentially blow through some of your small loss parameters, and you might take a little bit more of a medium loss. You're not going to take a catastrophic loss if you manage properly. Okay, so how do we do that? We set stops. Okay, a 2x stop, a 3x stop. Maybe, the problem in futures is that we can't put in orders for stops. Okay, that's the one downside. The upside to that is sometimes you can get stopped out before a trade even gets there, but it would be nice to be able to set stops. And I know if you're on Interactive Brokers, many of you guys can set stops. Beautiful, do it. If you're on Tasty or Schwab, Toss, whatever, you can't do that. You can't set your stops ahead of time. Okay, you can monitor the trade. You can pay attention to it. I will usually start to pay attention to a trade after it gets past 150% loss. Okay, so before it gets to 200, I start watching there, but I'm not going to watch it every 5 seconds. And oh my goodness, it's 170, it's 180. Okay, just chill, people. Okay, you sized it for a 200% stop. Don't worry about it. If it hits it, you move on. Okay, don't get emotionally attached to any particular trade. Just trade your plan and move on. Okay. The second thing you can do to hedge, besides setting your stops, okay, would be to buy something else that will gain in value while you're losing value. Okay. This, to me, is the smart play. Okay. Also, I'll go back to that, allocation piece. Don't put all your eggs in one basket. Don't just trade ES only. Okay. Trade other assets, oil, gold, bonds, cattle, livestock, which is cattle, agriculture, Forex, whatever you want to do. Mix it up at least a little bit. You don't have to be super diversified of even proportions, but don't put all your eggs in one basket. And another way to do that would be use multiple strategies. I don't just use one strategy. It's not all about the 1-1-2 trade. That's my bread and butter. It's been my bread and butter. I came up with the long-term 1-1-2. That's been my bread and butter as a campaign trade. But I also do strangles. I do naked puts. I do ratio spreads. Lots of different strategies that are out there to do. Diversify by strategy, diversify by days till expiration, and diversify by underlying. You do that, you're going to minimize some of the damage. In a major sell-off, older trades that have been on for 60, 90 days, they're not going to move or be hurt as much as a newer trade is. Okay? So if you're consistently putting trades on and managing them correctly, if a selling event happens and we start to drop 3% this week and another 3 next week and then 4 and then 2, and now all of a sudden we're down 10, 12%. That's what you want to pay attention to. Okay? And you can do this by being consistent. The other nice thing is as the market's falling and you're being consistent, you're putting on trades at different entry points, getting further away. So that when the market rebounds, and the market will rebound, the market goes up. There's positive expectancy that the market's going up. And if you believe Tom Lee, we're going to 15,000 by 2030, I believe. Okay, well, we're at 5,500 right now. So that means we're going to triple by the end of this decade. Okay, that's Tom Lee, and Tom Lee we trust. I hope you're right, Tom. All right, so if you believe that markets go up over time, which they do, and it's been proven, the market goes up typically 10, 11% on average every single year. It's going to go back up. You have to just weather the storm. So you want to prevent the big loss. Again, every big loss started as a small loss. Okay? Your problem is you didn't stop. You thought it would turn around, and it didn't. And then you thought, oh, I'll give it a little bit more time, and it didn't. Okay, and it just kept getting bigger, and eventually you stopped out, and you took a big loss. Most of you didn't follow some sort of a trade plan. Okay, I also want you to remember that hedges don't make you money; they mitigate damage. You don't need to go hog wild and hedge every single thing that you have and try to make sure that you're going to make $1 billion instead of losing 100,000. If you're doing that, you're spending too much money on your hedge and you're damaging your returns. I don't know what's worse, buying a hedge and damaging my returns, or not hedging at all, okay, and just taking the loss, but having made more money along the way. Okay. And there really is no perfect hedge. Okay. There's no great hedge out there that works in every scenario. Okay. The more you hedge and the more money you put into a hedge, or the more you want the hedge, the better you want that hedge to be, the more that hedge is going to cost you. So you've got to weigh how much I'm going to hedge versus what am I hedging versus is this even worth it to spend all of this money and wipe out all of my profits or half of my profits? Okay. You got to hedge appropriately. Okay. I'm going to address quickly the black swan hedge versus the way I hedge. Okay. Number one, the black swan hedge occurs every roughly 20 plus years. Okay. A 10 to 15% downturn will happen every roughly 1 to 2 years. Which one do you want to protect? The black swan hedge is not going to protect you against a 5 or 10% downturn. It's too far out of the freaking money. It's going to do nothing. It won't even start to move on you. It's not going to help you at all. Okay? It's not going to help you with normal markets. However, if you have a hedge that's designed to start to pay if we're down 10, 15% or so, that hedge would also help you in a black swan event because you're going to blow way past that and it should start to make even more money the farther down we go. Okay? So again, I'm not poo-pooing it, okay? But I'm telling you, understand what you're hedging and be smart about the whole thing and understand why are you putting on a black swan hedge versus why are you hedging against a 10 or 15% downturn, which is more likely, which is going to happen more often, and which one's going to help you most of the time. Okay. For me, I like to put on a 60-day hedge. I'm buying puts the way I feel to do it. If we blow past 10 or 12% down and we go down 30%, that hedge is going to pay off a heck of a lot more, okay, for me anyway. So I can actually hedge both things at once. And I'm going to give you my opinion, and most of you already know this, is nothing is free. Every hedge costs money. But Tom, the black swan hedge that everybody does out there that Ron Bertino put together that everybody's copying and calling the black swan hedge, okay, it's free, Tom. It's a free hedge. No, it's not. Okay. You have to sell puts, then close those for a win in order to pay for the puts you want to buy. That means you have to sell something in order to buy something. It's not free because you had to place a trade, make money from that trade, and then go buy your other puts. It's not free. The way I hedge typically is, instead of doing that, I just keep trading and I'm taking a small portion of my trades and I'm putting on my own hedge. Okay? I'm not selling something specifically so I could buy something with that money. I'm just selling stuff anyway, making as much money as I possibly can, and I'm going to allocate a small percentage of that income to hedging. So I do hedge. I do have hedges. Okay? I believe I'm doing what's best for my portfolio, which is what you have to do. If you can't sleep at night because you're worried about the black swan event, put on black swan deep in the money or deep out of the money hedges and just do it and sleep fine at night. You have to do what's right for you. Okay? But I do believe you've got to have those two things in place: stop losses, okay, sizing your trades appropriately, okay, and then you also have to have some sort of hedges on, depending on what you're trading. For me, because I'm trading naked puts on futures, I believe in hedging. If you're trading other things like SPY or just naked puts on SPY or something, and you're okay taking assignment, why would you hedge? What do you care? Okay? In my opinion, if I get assigned a bunch of SPY that's 20% out away from where it is today, knowing that the market's going to go up over time, it's going to go up 10 to 20% or something like that. I mean, this year, what is the market up this year? If we look, I'm going to tell you right now, the market's up 15% in 6 months this year. Okay? The market's going up. When it goes down, it goes back up. It's just a matter of, can you survive and limit the damage long enough to be able to recover? I'm okay taking assignment, especially if it's on SPY. If it's on futures, I don't love assignment on futures because there's a little bit more hassle because of the futures expiration and rolling contracts, but you can still do it out there. And you can pick and choose what you want to do. So again, prevent big losses. Okay? Every big loss was a small loss at one point in time. Okay, how do you do these? How do you do that? How do you prevent the big loss? Number one, you got to pay attention. Number two, you have to have a plan, and you have to follow that plan verbatim. And number three, if you can, you have to set an order for that to close. If you can't, again, it's back to paying attention and knowing what you do. And the best way, in my opinion, to hedge something is to buy puts against that. Whether it's the S&P, whether it's real estate, whether it's crypto, whether it's stocks, there's always something out there that you could buy puts on that's going to help you mitigate that damage. But again, the puts aren't meant to make you a ton of money. It's there to mitigate the damage, and there is no such thing as the perfect hedge. All right, so let me give you one more example and we'll wrap it up for today. That's my opinion on hedging. What do you do, Tom? How do you figure out how much to hedge? What you have to do is try to figure out an area of where would the market go in order for me to get stopped out on nearly everything that I have, even though it likely would not happen. But what if I was stopped on every single put? Well, I have a $510,000 account. Right now, as of a few minutes ago, I added up every naked put that I had in ES futures, and I doubled that amount. Okay, so I ended up finding $50,000 worth of naked puts on ES. I also included NASDAQ in there as well, because if ES is falling, NASDAQ is falling. Okay, I did not include gold. I did not include copper. I did not include oil. I did not include bonds. Okay, I'm looking at the S&P 500. $50,000 was the credit I have received, which means if I had a 2x loss on every single trade, it would be a $100,000 loss, which would be 20% of my portfolio. I can live with that. However, I've got hedges on, okay, and I've designed hedges that if we go down 15% or so in my account, those hedges should pay me probably $80,000 or so on average. Right? So will it totally absolve me from any damage? No. However, I'm going to mitigate most of that damage. Okay? So that's my goal, is mitigate the damage out there. Figure out what works for you. Okay? If it's the black swan hedge, knock yourself out. If you want to buy puts, knock yourself out. If you want to do nothing and just set stops and monitor your account, knock yourself out. You have to do what's right for you. Just understand that trading is risky. Trading futures is risky. Trading options on futures is risky. And that you should do something in order to mitigate any potential damage. I want you to be smart. I want you to be safe. And we'll see you guys in trading tomorrow. I hope you take this and use it. And if you feel you got some value, click the like button down below. Subscribe to the channel if you haven't. And if you want to see exactly how we hedge, exactly how we set up the portfolio, exactly how we trade, and get into the educational part of it, come join us in the Discord. All right, we'll see you then. Bye-bye.